Oil rising as the Middle East conflict deepens and fears of disruption rise. Joining us right now is Daan Struyven, who is Goldman Sachs co-head of global commodities research. And Daan, we've been trying to figure out why oil prices haven't reacted a little more drastically from the horrific things that are happening in the Middle East.
You definitely see some significant responses in option markets. The cost of insurance against large price spikes in near term has risen significantly. But indeed, if you look at the flat price, you're still in the mid-70s for Brent, low 70s for WTI. And on our models, that is still about $5 per barrel below the fair value implied by the level of inventories, which are moderately below the historical average. So the question is, why is this reaction in flat price to heightened geopolitical uncertainty so muted? I think there's two key reasons.
That's interesting with the options. Is there higher prices, but also extended activity in the options markets right now, too?
We've seen a flurry of activity as investors try to buy insurance against perhaps not the central case in their view, but the risk case where you do see significant supply disruptions and a spike.
Okay, so maybe we're seeing a lot more options activity than we've seen in the past, and that might explain some of this. What are the other reasons?
The most fundamental reason is that there's about 6 million barrels per day of global spare capacity, basically shut-in production, that in most geopolitical disruption scenarios is likely to come online to offset any potential tightening effects from lost supply. That's the most important reason. And the other reason is that if you look back at the last couple of years, despite two very significant conflicts in two major oil-producing regions, Russia, Ukraine, the Middle East on the other hand, we haven't really seen sustained large geopolitically driven supply disruptions.
We have seen at the same time China add some massive stimulus that over the last couple of weeks has led their stock market to jump 21%. If stock market investors are so convinced that this is going to pay off and really stimulate the economy there, why isn't the energy market more worried that that is going to really jack up demand and put more of a crimp on things there, too?
Absolutely. We have seen very significant reactions in Asian equity prices, large reactions in metals prices, and fairly muted reactions in the oil market. I think it has to do with the fact that a lot of these stimulus measures are directly targeting the Chinese stock market. Second, that China...
Not necessarily as much consumers.
Consumers, right? No. China accounts for about 50% of global demand for most of the metals, only accounts for about 16% of global oil demand. The US remains the largest global consumer of oil, about 21%. And last but not least, we do think that several of these measures that may be implemented may actually accelerate the shift away from oil into alternative fuels. For instance, EV recharging infrastructure being built out, scaling up the trade-up schemes where you can swap your gasoline-driven car for an EV car. So the impact on the overall economy may be larger.
That's a long-term play, though, because right now the story is nobody wants an EV car, and they're turning these things back in, and companies are cutting production plans.
That is definitely something we're seeing in many Western markets. The situation is a bit different in China, where the share of EVs in new car sales is just over 50%.